Back in action. Getting more acquainted now with inventory. Developing our inventory skills. We know how to now journalize in a perpetual and periodic system. We know the distinction between both. We know why you would use a periodic, why you would use a perpetual, how to journalize purchases and sales in each of those systems. And we will be journalizing them exactly the same way in this chapter. But what this chapter offers is a means of calculating the amounts that we will be journalizing. Not the accounts, but the amounts. Particularly the cost of goods sold and the merchandise inventory amounts. How do we get them? By using our costing methods. If those two systems in chapter 5 are called perpetual and periodic, they're called systems. The three methods on getting the cost of goods sold and merchandise are going to be called costing methods, not systems. Okay, that's how we'll distinguish terminology with them. And we will be talking about three of them. Three costing methods. FIFO, first in, first out. Weighted average method, sometimes called moving weighted average method. And it's moving because it's always changing depending on date and adding more inventory because you purchase more inventory. So we'll demonstrate. And then specific identification. This is the third method on getting your cost of goods sold figure. So you now can plug that figure into the journal that you already know how to do from chapter 5. So that's the main focus of this chapter. We will also talk about net realizable value. Oh, by the way, just back to those three methods. There's a LIFO method as well, a fourth method. Last in, first out. But for this course, don't worry about that. Just the three that I mentioned. FIFO, weighted average, and specific identification. Those three. Now, the next point. Net realizable value compared to cost. We'll get into that. And then I'll conclude the video with two ratios. One or two formulas, two kind of calculations relating to our inventory. How long does it take us? Well, actually, how many times are we selling our inventory over the course of 12 months? And how long does it take us to sell each load of inventory in that 12-month period? And those two formulas are called the inventory turnover ratio and the days the sales is in inventory ratio. And then we'll explain how they are related, and I'll even give you a quick way to calculate that days in sales inventory ratio after you calculate that inventory turnover ratio compared to what the textbook offers. So I'll show you both ways to do it. So that's what we'll talk about. Everything that is discussed in this video, of course, I'll also put it in the test review for anybody who doesn't watch the videos or anybody who misses the video. But the point is that this video will offer you some explanation on what you are reading about in the PowerPoints and in the textbook, on how the figures are derived at and what things mean and all of that. Test 2 will be next week, and it will be due on the following Sunday, right? Because, so you have that full week to do test 2, and if you want to theme it, it's just about inventory. That's all you're talking about, the one asset of inventory. You're not talking about any liabilities. You're not talking about equity, directly at least. You're not even talking about assets in general. You're just talking about one asset. What is the one asset? Inventory. So that test is on inventory, chapters 5 and 6. Okay, so talk about how 5 and 6 are related. Did a little bit already, but I'll demonstrate some things. And that's that. 2 chapters, 5 and 6, next week, test 2, appendix 2, which is the final chapter to cover in this course, will be put on top of the exam as in addition to the previous 6 chapters for that comprehensive exam. Okay? So appendix 2 is not separately tested, it's just thrown onto the exam. Appendix 2 dealing with special journals. We'll, of course, talk about that at that point. So, let's start out with the costing methods. FIFO, weighted average, specific identification, and how we calculate cost of goods sold and inventory in each of those methods. Okay? Again, systems, we're talking about periodic versus perpetual. Methods, we're talking about these 3 costing methods. First, we'll talk about FIFO. So, we start with a beginning inventory in all 3 systems. So I'll do a table similar to the table demonstrating the periodic perpetual journalizing. But this one will have 3 columns. FIFO, and let's just focus on FIFO for now. We'll have a beginning inventory amount, let's say 20 items at 10 per unit. Items at 10 per. What FIFO means, first of all, is you're getting, it's first in, first out, that's what the acronym stands for, and it means your oldest inventory is leaving first. So you're keeping your newest inventory around still. What comes in first, leaves first. What type of businesses would use this kind of system? Method. What type of business would use this kind of method? Perishable. Anybody selling perishable goods? So food is something that's quite obvious with this. You could even say, I mean, depending on who you talk to, you could say plants, but anything that will have a certain lifespan, you want to sell that first. And therefore, those type of businesses will be utilizing this type of method in getting a unit cost for their cost of goods sold and inventory. And the purpose of all 3 of these methods is to determine that unit cost of the inventory and cost of goods sold. Okay, so we can calculate the cost of goods sold in the inventory. Let's get to it. Beginning inventory, we have 20 units to start with at $10 a unit, our cost. And another thing to keep in mind is that these numbers that we're talking about are our cost. When you purchase inventory, again, it's sitting there with the intention, our intention to sell it. It's not sitting there for us to use it for anything else. Okay? So when you purchase something, you could say in regular English that you purchased a vehicle or a cabinet or a dish set, plate set, whatever. And that makes sense. But in accounting, when you say purchase, and it just says the word purchase of goods, then you automatically are referring to inventory, even if it doesn't say the word inventory. Okay? So yes, in accounting, it could also say you purchased equipment, purchased a boat, whatever you purchased. But if it just says purchases, and it doesn't follow with the word inventory, then you know it's talking about inventory. And that's why when we say purchase additional goods, we're talking about inventory. So you have a beginning inventory of 20 on March 14th. And now on March 15th, you purchase more. Purchase 30 more at, so we're anticipating that we're going to make some sales. We bought even more inventory even though we have not yet sold this amount that's already sitting there. And let's say you purchase this one at $12 a unit. Okay, $12 per unit. So, now comes March 16th. And I know we have some salespeople, some sales personalities in this class that can sell the products we've been sitting on in a day, if not quicker. And so we've already made the sale on March 16th of, let's say, 40 units out of, how many do we have available for sale? 50. 20 plus 30. We have 50 available for sale. And now on March 16th, we actually sell 40 of them. At, what are we marking it up at? Let's say $20. All right. So let me just see if this angle is better, is it? Yeah. So you see what's happening here? March 14th, we're just recording our beginning inventory, which is the ending inventory of the preceding cycle. So let's say we're doing it monthly, maybe that's from February. I know we're saying March 14th, it should be March 1st, but you get the idea. The beginning inventory in this period is the ending inventory from the last period. And this is simply just recording what that is on March 14th. On March 15th here, we're purchasing additional inventory. So therefore our total inventory before a sale is obviously higher, 50 units. Now on the 16th, out of those 50, we're selling 40 of them. And of course, it's going to be at a higher price because that is our selling price now. Pay attention to if it's a purchase or a sale. Okay? You already know how to record the purchases. Chapter 5 video if you need the reminder. But purchases is always one entry in both systems, periodic and perpetual. It's just in the perpetual, instead of purchases and purchase returns and allowances and purchase discounts, you're using the inventory account, right? In the perpetual, because you want that updated value of inventory after each purchase, after each sale. And in the sales entries, you are recording one entry in the periodic system for all of the sales, sales returns and allowances, and sales discounts. But in the perpetual system, it's a double entry for sales. It's a double entry for sales returns and allowances. Remember? And when you do the double entry, you're recording the cost of goods sold with that. So you cannot record the cost of goods sold unless you have made a sale. And that's what we have done on here on March 16th. Okay? So purchases, I won't journalize that. You already know how to record that. Just use the inventory account if you're recording it in the perpetual system. Use the purchases account if you're recording in the periodic, but either way it's one entry in both systems for purchases. Now comes the sales. Let's say we're getting cash this time. Customer pays us with cash. They bought 40 units from us at $20 each. Okay, so what's that, 800? Is that 800? Yeah.
Just walk in the doors.
Yeah, sure. Thanks, man. We're locked in. We're locked in. You're here to stay. $20. Excuse me. $20 per unit, selling 40 units. $800, if my math is correct. Yeah. So that means we're receiving cash. Debit for 800. Credit, what do you want to credit here? Sales. It's revenue. You can call it sales revenue, you can call it revenue, you can just call it sales. We'll call it sales, 800 credit, right? And in the periodic system, you're done. This one entry satisfies the periodic system. But in the perpetual, we have to do that double entry and record the cost of goods sold. And how do we know how much cost of goods sold and inventory we are going to record here? We know based on the method of calculating that unit cost. And in this case, it's the FIFO. How do we calculate it in the FIFO system? So we sold 40. Remember, first in, first out. That means the oldest stuff gets sold first. What is the oldest stuff? From March 14th. We go to the first date. March 14th, 20. We need 40. March 14th only has 20. So that means we're going to take all 20 from March 14th to start. So let's go over here now. All 20 from March 14th at the unit cost of March 14th, which is $10 each. Remember, cost is our cost. If we say cost, that is what we pay for it. If we say price, that is what we sell it for. So, we're taking all 20 at the $10 unit, but we know we sold 40. So we have to get 20 more units from the next date, if it has it. Does the next date have 20 more? Yes, it has 30. We're going to take 20 out of those 30 from March 15th. So that we can get this 40 total of what we sold. And we're going to pay attention to what the unit cost of those 20 are from March 15th. What is it? $12 per unit. Okay. 20 times 10, 200. 20 times 12, 240. What is the total cost? 440. Okay. This is our total cost using the FIFO system. Cost of the goods that we sold. This is our sales amount, our revenue. And this is our cost of that revenue. You see? So in chapter 5, we were given this amount. Cost of goods sold is provided, or we showed how to calculate cost of goods sold by using that beginning inventory plus purchases minus ending inventory calculation. So that's that. But in this chapter, we are actually calculating the cost of goods sold by using one of these methods instead of that standard calculation that was demonstrated. Okay? So, of course, in this case, it's the FIFO system. We're demonstrating how to get the numbers. Remember, always total the amount of your cost only in the amount of what you sold. Let's say, hypothetically, we had 50 units in beginning inventory. Let's say we had 50 in beginning inventory and we still purchased the additional 30 on March 15th. Then that means we have 80 total, and then on March 16th we still sell the 40. Then you take all 40 from the March 14th because it has enough in March 14th. It has 50, we'll take 40 of it, that means 10 is still remaining from beginning inventory. You get that? You only go to the next date if you need to get to that total of sales. Units wise. So now this 440 is what we're going to record, that second part of the double entry of this sale. Why that second part? Because it's the perpetual system. Again, periodic, that's all you need to do. Perpetual, now we're going to say cost of goods sold, debit for 440, merchandise inventory, credit for 440. Our cost and what we actually sold it for. Price to the customers. Got that? And therefore these two entries together are the double entry for or in a perpetual system. be mindful of how the unit prices might change from one date to another, so that you're not just robotically saying 20 times 10, 20 times 10, you know. You're clear on what the unit price is for each date that you are including in the calculation. So you look to each date, get the detail, and then go forward. All right, that's the FIFO system. Now the moving weighted average, we'll use the same numbers. I won't erase this. We'll use the same numbers, but we'll show that this cost will be different in the moving weighted average based on the additional purchase. So, and again, moving weighted average, because each date that you add inventory to the total of inventory, which is the goods available for sale, every time you add to it, it changes the weighted average amount. So let's show how that works. Moving weighted average. All right. So this is FIFO. I'll do the moving weighted average calculation up here. And we need to first, before we even talk about the sale, let's pretend that the sale is not even written here. Let's pretend it's just the March 14th and 15th information that we're dealing with. So we need to first get a unit cost, a unit average cost, that we are then going to multiply into the sale, the total sales units, when that happens. Okay? So first get that unit average cost, which goes along with the moving weighted average calculation. How do you calculate it? You need to get an average of your total units. How many total units do we have? 50, right? 20 plus 30. So we take the first 20 times 10, put it in a bracket, add it to the next 30 times 12, again, pay attention to the unit cost. Okay? So that's your numerator, those two brackets. Divide into that the total units that you have available for sale, we just said, is 50. Okay? So let's do this calculation. Well, we know it's going to be, no, actually, hold on. 20 times 10, okay, plus bracket, 30 times 12, end of bracket, equals 560 divided by 50 is 11.2. Okay, 11.2 represents our average unit cost. So it's somewhere in between this 10 and 12. That makes sense? The reason why it's not exactly 11 is because we have different amounts here. We bought more on the 15th than we had on the 14th. You see? So that's why it's 11.2. That's the first step in the moving weighted average. Just get an idea on your average cost for the inventory that you have on hand right now. That's the first step. Now take that 11.2 and simply multiply it by the amount of units that you sold. So the 11.2 times, how many did we sell? 40 units. And what is that? Slip it here. 11.2 times 40, 448. So you see, 448 now in the moving weighted average method is our cost instead of 440. So same thing, cash 800 debit, sales 800 credit, cost of goods sold 448 debit, merchandise inventory 448 credit. Slightly different. By the way, who uses a merchandise inventories method? Companies that have like products. Maybe they're selling one kind, mass quantities of one kind of product, and therefore you can average it out since it's all relatively worth the same and it's all undifferentiated in terms of what the product is. The product is the same regardless of when you bought it. Okay? So when you have more similar products in a mass quantity, then you're able to average it out and therefore use the moving weighted average. So the only difference is the numbers change here, but it's the same entry. Again, double entry in a perpetual system. The periodic ends at this cash sales of 800. That number stays the same depending on what you sell it for. All right? Okay, and now let's just add in another hypothetical. Let's suppose before the sale. So I'll just verbalize this part. Let's say we make this sale on the 17th instead of the 16th, and therefore on the 16th we make an additional purchase of, let's say, 30 more units at $10. Okay? Now you will take your existing amount and just put a third bracket now of 30 times 10 at the top. Don't forget to change your denominator at the bottom with that additional amount of units, so it goes from 50 to 80 now. 50 plus 30, okay? So here you go. And then, of course, you will have a different moving weighted average amount. Again, moving, the operative word, because each date and each time you add to the inventory, your average inventory cost per unit is going to change, right? So our example with the 11.2 is just after 2 dates, but if you have 3 or 300 dates, you just do the same thing. And you could take the result already from these two and just add that third bracket. That's fine too, to make it a quicker calculation. But that's why it's called moving. Okay? So you got that? Now, let's erase this. Leave this, put this back to 50. And now we have specific identification. What type of business uses this method? A business who has product differentiation. Okay, let's get into the garbage disposal business. I have a garbage can in front of me here. But let's say those standard garbage cans that you see in classrooms, I have one here, I have one in the corner over there. You might have it in your bedrooms, your kitchens. Okay, those are relatively inexpensive compared to a sophisticated, more advanced garbage disposal machine or system. Let's suppose those are our two products. So yes, they are related in terms of being both for the garbage, but not only are they different looking, but the price is a lot different. And therefore, if we want to record the cost of goods sold and the inventory for the disposal system, it's obviously going to be much higher than these regular garbage cans. Contrasted to this moving weighted average type of business that has all similar products in mass quantities. Okay? And then if you want to just extract a particular product, a specific product, then you'll be using the specific identification method. And it is more in line with the FIFO system in terms of how you calculate it. So let's calculate. Again, we'll use the same numbers, the same dates, everything is happening the same way. So we sell 40 units on March 16th, but to get that 40 total, we'll take, let's say we'll take 10 from March 14th. We want the specific 10 items out of the 20 from March 14th. Again, specific identification, maybe 10 garbage disposals. The other, because we want to specify that specific product. 10 garbage disposals times, what is our unit cost of those 10? 10. Okay, we can put it in brackets here. And then that can be added to, so that's 10. We sold 40. How many more do we need? 30. We'll go to the next date. See if we can get 30 from the next date. Yep. So we'll take all 30 from March 15th, since we only have 2 dates to work with. If we had a third date, then we might just take a portion of this 30 and then a portion of the next date's units to compile that total of 40. But in this case, we have 2 dates of inventory. So let's take all 30 from the second date, because we have to. 30 times how much is the unit price? 12. And now 100, 460 total, right? Yeah, I think so. I feel good about it. 460. Okay. Okay. So guess what this represents? Our cost. And it represents the amount of the inventory that has gone down for us by means of making this sale. So, cash 800, sales 800, debit cash, credit sales, same thing. Cost of goods sold, debit for 460. Merchandise inventory, credit for 460. Why is merchandise inventory always being credited in these three? Because we sold the inventory. So the inventory is leaving our warehouse, leaving our location, therefore decreasing. We need to credit it opposite to its natural debit balance. So the only difference in these three systems is the amount, 440, 448, and 460, that we attribute to cost of goods sold, an essential expense account, essentially an expense account, and then to merchandise inventory. You see that it's highest in the specific identification. I mean, these numbers can fluctuate. It's not always necessarily like that, but in this case, this is what it reflects. And therefore, how we can interpret this, how we can provide further analysis, especially related to the concepts we've learned thus far, is this company who's most likely selling perishable items, items that need to be sold in accordance to when they were purchased. What was purchased first gets sold first. They are recording lower expenses, 440, than these two companies. And if they're recording lower expenses, what do they have more of on the income statement? Profit. You deduct less expenses from your revenue, you have more profit. And therefore these have less profit in relation. Okay? But that's it. Now how we can also make a connection with these three methods is by comparing the cost of goods sold, ending inventory, and goods available for sale comparison, where cost of goods sold, we've just proven, is different in all three methods when you compare them to each other. So those three numbers will always be different. I guess in rare occurrences they'll be the same, but generally speaking they will always be different. Ending inventory. Since you are decreasing your inventory by different amounts in each of these systems, you're decreasing it more in this specific identification system than you are in both of these other systems. You're decreasing the inventory more. So if the inventory is decreasing by more, we're getting rid of more of it, that means we have less of it remaining in ending inventory. Very basic stuff there, right? You get rid of more inventory, that means you have less remaining inventory. So therefore, specific identification company has an ending inventory lower than these two. And therefore the highest ending inventory is which of the three? The highest ending inventory? FIFO. FIFO because it's getting rid of the least amount of inventory by way of this sale. You see? So that's why, so there you go. We've proven cost of goods sold is different. Now we just explained how ending inventory is different. And cost of goods sold plus ending inventory is goods available for sale. There's a minor calculation there, right? But it relates well to what we've been discussing. Cost of goods sold plus ending inventory equals goods available for sale. But that cost of goods available for sale will be the same in all three systems though. It's just the cost of goods sold and ending inventory that is different depending on which method you use. But the goods available for sale will ultimately be the same as long as you're using the same numbers. Right? So we did in this system, we will have cost of goods goods available for sale will be equal in all three. Net realizable value now. I can verbalize this part as well. The key here is to distinguish between expected and actual. There you go. Expected and actual. We have the products that we purchase. Now we expect to sell them at a certain price, or we might have it already negotiated in our minds what we're going to sell it for. So that's the expected price. Now you deduct from that expected price, highlight expected, you deduct from that your cost of the sale. And remember, cost is an layered calculation. It has a lot included in it, particularly if we're assembling or manufacturing the product ourselves. We have the raw materials, the direct labor, the storage fees as it's going through its assembly, the insurance associated with that assembly and those products that we're assembling, the transportation in or the freight in, okay? Recording transportation in and freight in those are essentially expenses, right? We're talking about costs right now, so all of this is expense related. Transportation in, freight in is what the periodic system calls the account. And in the perpetual system, you're not going to call it transportation or freight in, you will call it inventory. Right? Your inventory is increasing because remember, inventory is a cost. It's what we purchase the inventory for. So transportation in is an aspect of that inventory. It's a detail in that inventory. So all of those things go into the cost of the product that we're selling. When we get that total cost, you deduct it from the aforementioned expected selling price. And then the difference is essentially your profit or your expected profit. So again, highlight the word expected. We can expect, based on this selling price, based on our estimated costs, that we will generate this profit. If that expected profit is lower than your actual cost, what you actually factually pay for that inventory, then the lower of those two amounts will be recorded in your financial statements as the cost. Okay? The lower of the net realizable value and the cost. This is a concept in the chapter as well. And this is where another principle comes in called the faithful representation principle of accounting. And that's all it means. Yet you're recording the lower of your cost or your net realizable value. And realizable is not necessarily factual. What more could you want? What more could you ask for? Realizable is not necessarily factual. But you record the two to satisfy the faithful representation principle. Also, in relation to these three methods, whichever one you're using, you have to continuously use. So once you commit to one, you're using it all the time. And it becomes very simple if you are always the same type of business. So if you're doing the food business, you're running the operation with perishable goods, then it's easy to just apply the FIFO system because it works naturally with the way your business is operating. You're getting rid of the oldest stuff first. First in, first out. To make that association, just say FIFO food, food FIFO. Okay? That's how you'll remember what type of business uses the FIFO system. Right? So once you commit to one of the systems, you use them in every period. Every period, and that is called the consistency principle. Another principle in accounting. Consistency just means you're staying committed to that method. There you go. There's another discussion in this chapter. Gross profit ratio and then retail cost ratio. Don't worry about those. Skip that completely. Of course, if you are interested for yourself, but I won't test you on that because those are not the foundational points of this inventory discussion. The foundational points are those two systems from chapter 5 and these three methods in chapter 6, as well as what we just discussed, the net realizable value, and then coming up we'll talk about the two other formulas. The inventory turnover and the days in sales is in inventory, okay? And then how they relate to each other. But the retail cost ratio and the gross profit ratio, I won't test you on that. And I will obviously give you a review as well in Blackboard, or it might not be obvious to you, but I will give you a review in Blackboard, and you won't see that as part of the review. But what we will say about gross profit is when we discussed it in chapter 5, we were talking about net sales at the top of the income statement minus cost of goods sold gives us gross profit, and then from that gross profit we deduct the rest of the operating expenses to give us an ultimate net profit or net income. And then the gross profit ratio from chapter 5 is finding out, or what it represents is how much of your sales represents profit, or how much profit do you make in relation to your sales, however you want to phrase it, okay? So that's where gross profit will apply. To the chapter 5, we already discussed that. We talked about how to calculate it. Go to that video if you need that. And what gross profit even means, okay? Gross still implies we have to deduct something. What is that something? The rest of the operating expenses. Okay, so gross profit stays in chapter 5. Don't worry about it in chapter 6. Now we'll talk about the ratios. The inventory turnover ratio and the days sales in inventory ratio. How long has the inventory been sitting in? How long have we been sitting on the inventory before we sell? So I'll show you the way that the chapter calculates it, and then I'll show you a quick way to get that days in inventory calculation after you calculate the inventory turnover. So inventory turnover ratio first. Let's write it out. We have a whole board here. Inventory turnover ratio. What does it mean? I'm asking. While I get a drink. What does it mean? Okay, yeah, there you go. How many times are we selling that inventory over the course of 12 months? So if it's a bulk amount of a certain item, particularly in the weighted average, moving weighted average method, then you're selling a particular quantity in a certain frequency of time, times over the course of 12 months. That's what it means. How many times are we selling the 1,000 markers in the year? Not one marker, but the full 1,000 counts as one bundle, and that one bundle of 1,000 markers, how many times are we selling that one bundle over the year? That's what this determines. And how do you calculate it? You take your cost of goods sold, so we're clear on what that is, divided by your average inventory. Inventory turnover ratio. What is the cost of what we sold? Right? So we generated the revenue. Our cost of generating that revenue, let's say, is $1,000. Of course, it'll be more over 12 months, but just we're just demonstrating exactly what it means and how to calculate it right now. Numbers are not that important right now. Average inventory implies that we're taking two numbers, or we're taking more than one number. Average means you're taking more than one number. In this case, it means two numbers. What are those two numbers? Beginning inventory and ending inventory. So what is the beginning inventory amount? Let's say, let's say 100 plus ending inventory. So after the period, how much do we have left? We'll say 50. End of bracket divided by 2. You see? So here we go. I'll just do a square bracket here, square bracket here. This is the main division sign for the equation. You see? So the denominator, the bottom of the equation, is this. And the 100 is your beginning inventory, the 50 is your ending inventory. The 150 that those combine to get divided by 2 to give us 1,000 divided by 75, right? 150 divided by 2. What is 1,000 divided by 75? 13.33. So 13.33 times per year we are selling that amount of inventory. Again, it's a large quantity of inventory. In other words, we're also ordering that amount 13.33 times per year. You see? So, in other words, each of those times lasts a little bit of time, and of course, you get an idea of how long it lasts when you're operating your business, right? In a periodic system, that's where the owner or the manager is more confident to be able to determine the amount at the end of the period without such a sophisticated, detailed recording as with the perpetual system. But overall, this is the amount of times that the inventory is being sold per year, just based on these numbers. Okay? 13.3. Now you have the days in inventory. So days sales in inventory. Days sales in inventory, okay, is calculated by taking now the opposite. We're saying average inventory I'll put it here, divided by cost of goods sold, this will be 1, multiplied by 365. That's how you calculate it. So here's the name of the, and this is the actual formula here. Under the line is the formula. Okay. There you go. And what this tells us is how many days is that inventory sitting? Each of those bundles, how long are they sitting in our inventory before we sell them? How long are we waiting to sell them? And then this is very helpful when doing those purchase requisitions. Remember from chapter 5. Purchase requisitions where you are ordering a very precise number of inventory so you're not overdoing it or coming up short. Okay? You're very clear on how much you need based on how much you've sold, based on what you're projecting to still sell, and how many days that the inventory is sitting in your inventory account and in your warehouse will determine how much you order and how often you order it. That's where the number becomes useful. So this is how the chapter asks us to calculate it, and let's calculate it that way, and then I'll show you another method. So average inventory, same thing. So we'll take that 75, okay, equals 75 over cost of goods sold. What is it? 1,000. Okay, so bracket, put that in bracket, and then times that by 365. What does this mean? Calculate to. 75 divided by 1,000 is 0.08 times 365. 27.38. $27.38 days we are waiting before we sell each bundle. You see? We're waiting 27.38 days. And of course, it's a bundle, so it's multiple products. It's not just one item, again, to be clear on that. Now, an alternate way to get this number, or to get a number close to this 27.38, is to just take this 13.33 and divide it into 365. So that's why the inventory turnover ratio needs to be calculated first if you're going to do this quick calculation. But once you have the turnover ratio, 13.33, bring it up here, say 365 divided by 13.33, that should give us something close to 27.38. I don't think it'll be exact. Oh, actually it will. It will. But it's not always exact. 365 divided by 13.33. Yeah. It is exact in this case. 27.38. Okay, but it could have said 27.52. Okay, it would have been in the vicinity. It still gives you an idea. But in this case, our numbers are working out beautifully. So there you go. So this is all you have to do instead of this to get the days the sales are in inventory. And that's what they mean. Rewind if necessary. Be clear on the methods. Be clear on perpetual versus periodic. You're using both of those systems when journalizing. How do you get the amounts? By using the methods that we compared and contrasted here. And again, next week, test 2, you have the extension this week, or of this week's assignment, till Wednesday still of next week. And test 2 you will have available until the end of next week, the Sunday. So this still gives you ample time to really look over everything, study everything, integrate the concepts from both chapters. Remember, the test is all about inventory. If you have any questions, let me know. Post them in the discussion board. Look over the practice questions if you want me to discuss any specific ones of those. Pass that along. And also when the lab becomes due on the Wednesday, I can discuss any of those questions if you have any at that point, in between the Wednesday and the Sunday due date for the test. But the test will be available on the Monday for you. And then you will, of course, have the whole week to do it. Okay? And again, Appendix 2 gets thrown onto the exam. So any questions about anything, discussion board, email, and we move along. Okay. Bye for now.